Hey everyone, it's Rockstar. Let's be real, when you hear the word bonds, does your brain instantly switch off? It's not exactly the most exhilarating topic, but trust me on this, understanding bonds is absolutely crucial to building long-term wealth. It's not just about stocks, you know. Today we're diving deep into the world of bonds. We're going to break down the different types, who issues them, and what all the jargon means, so you can make informed decisions with your money. Let's get started. First up, we've got government bonds. These are issued by governments to fund their operations. You've got your treasury bonds, backed by the big dog, the United States government, considered one of the safest investments. Then there are savings bonds, also backed by the government, but these aren't traded, so you hold on to them. Municipal bonds are issued by local governments, think states, cities, even counties, to fund things like schools and roads. These can be tax-free, which is a huge plus. And finally, we have sovereign bonds, which are issued by foreign governments. Think of these like treasury bonds, but with a little extra risk because, well, they're not from the United States. Now, before you go throwing all your money into government bonds because they sound safe, remember, even with the United States government, there's always some level of risk. Plus, the returns on these bonds are usually lower than riskier investments, but hey, you're getting that stability. It's all about finding that balance, right? Next up, let's talk about corporate bonds. These are issued by companies, not governments. And guess what? Companies can default on their debt. That's the risk you take. But on the flip side, because they're riskier, they usually offer higher interest rates than those safe government bonds. Think of it like this. You're basically lending money to a company, and they promise to pay you back with interest. Sounds simple, right? Well, here's where it gets a little tricky. You've got different types of corporate bonds. Investment-grade bonds are issued by financially strong companies with good credit ratings. These are considered less risky, so they offer lower interest rates. Then you've got high-yield bonds, also known as junk bonds. These are issued by companies with lower credit ratings, meaning they're considered riskier, but they can offer those juicy high interest rates. It's all about how much risk you're willing to stomach. Now let's talk agency bonds. These are issued by government-sponsored enterprises or GSEs like Fannie Mae and Freddie Mac. Remember those names from the 2008 financial crisis? Yeah, those guys. Anyway, these bonds are generally considered pretty safe because they're backed by the government. But here's the catch. They're not always explicitly guaranteed by the government. So, there's a tiny bit of risk there. Agency bonds typically offer slightly higher interest rates than treasury bonds, but less than corporate bonds. So you're getting a little bit of that extra return without taking on too much extra risk. It's all about finding that sweet spot in the risk-reward spectrum. Remember, diversification is key. Let's talk about convertible bonds, which are a bit more complex. These bad boys give you the option to convert your bond into a predetermined number of company shares. Think of it like having a foot in both the bond and stock markets. You get the stability of a bond with the potential upside of owning stock. Sounds pretty good, right? But of course, there's a trade-off. Convertible bonds typically offer lower interest rates compared to traditional bonds because you're getting that added benefit of potentially converting to stock. It's all about weighing your options and deciding if the potential for stock growth outweighs the lower interest payments. Next up, we have zero-coupon bonds. These are a different breed altogether. With zero-coupon bonds, you don't receive any regular interest payments. Instead, you buy the bond at a discount to its face value, and then receive the full face value when the bond matures. Think of it like buying something on sale and then selling it later at full price. Zero-coupon bonds can be a good option if you're looking for a predictable lump sum payment in the future, like for retirement or your kid's college fund. But keep in mind that you won't receive any interest payments along the way, so you're missing out on that compounding growth. Now let's talk about inflation. We all hate it, right? Well, inflation-linked bonds like TIPS, Treasury Inflation Protected Securities in the US, are designed to protect your investment from the erosion of purchasing power caused by inflation. These bonds adjust their principal and interest payments based on changes in inflation, as measured by the Consumer Price Index, CPI. So if inflation goes up, the principal value of your bond increases, and so do your interest payments. And if inflation goes down, well, the opposite happens. Inflation-linked bonds can be a good option if you're worried about inflation eating away at your returns, especially in today's uncertain economic climate. Last but not least, we have perpetual bonds. These are the marathon runners of the bond world. They have no maturity date, meaning they can theoretically last forever. The issuer will pay you interest payments forever, as long as they don't go bankrupt or decide to call the bond. Perpetual bonds can offer a steady stream of income, but they also come with interest rate risk. If interest rates rise, the value of your perpetual bond could decrease. So, it's essential to consider the current interest rate environment and the creditworthiness of the issuer before investing in these types of bonds. And there you have it, a comprehensive look at the different types of bonds. We covered everything from the super safe government bonds to the more complex convertible and perpetual bonds. Remember, bonds can be a valuable part of any diversified investment portfolio, providing stability and income. The key is to understand the different types of bonds, the risks involved, and how they fit into your overall investment strategy. Whether you're a seasoned investor or just starting out, understanding these bonds can help you make more informed investment decisions. Don't be afraid to do your research, ask questions, and seek professional advice if needed. Remember, investing is a marathon, not a sprint, and the more knowledge you have, the better equipped you'll be to reach your financial goals. Thanks for watching, and don't forget to like and subscribe for more financial insights.